something that I'd like to say today is that you get out in what you put in. So if you do have any questions, please fire them through and we'll attempt to answer those as we go through or towards the end. My name is Tony Sarai and I am an Associate Director and Executive Planner here at Modoras. And joining me today is James Morris, who is a Director and a Chartered Accountant here at Modoras as well. And to kick things off, I'll hand it over to James.
Good afternoon, everyone. Welcome to the seminar. Today we're looking at the 2018 federal budget, which is predominantly made up of the four key areas: taxation, super, aged care and social security. The budget handed down compared with 2016-2017 budgets, there's no significant changes that will impact clients, but there's some important little strategies that we can start to look at that might provide some opportunities for people. And it's important to understand, obviously, that the budget is just an announcement at this point. None of this is in legislation, so we've still got to negotiate the Parliament, both the lower and upper houses, and also wait for the opposition's speech tonight as to what their opinions are going to be on the budget. But in broad terms in the budget, before we get into some of the detail, the budget deficit is being forecast at 18.2 billion. And when you compare that with 2 years ago, that's less than half of what the deficit was 2 years ago. And the government is projecting in 2 years' time that they'll have a modest surplus of 2.2 billion, which is positive. And that's one of the things out of this budget is that it's a rosy budget. It's a happy budget because they're looking at consistent growth in the economy. They're forecasting 3% growth in the economy. They're looking at, I suppose, some of the underlying assumptions is that they're trying to keep tax collections at 23.9% of GDP. And the government are working on the principle that if we can decrease taxes across the board, that'll increase and stimulate investment, which will increase growth, increase demand for labour, and increase wages. So they're looking for positive outcomes. One of the things the Treasurer did say was that they're no longer borrowing to pay for everyday expenses. So that's one of the positive things that are happening within the budget, is that they're no longer relying on borrowings to balance the budget. So one of the first key measures that we're going to look at is the taxation aspects. And there's a number of changes, but again, I'd probably say they're not significant changes. Possibly the personal tax cuts, when we get into those, are probably the biggest area. But the majority of this budget is all about just consistency. There's no real major changes happening here. And that's probably one of the criticisms of the budget, is that there's no major tax reforms to some of the underlying problems that we have in our tax system with the complexity. There's no simplification. There's no, I think, pre-budget there was a lot of talk about franking credits, no changes there, no changes to Division 7A, taxing of trusts. So there's some major issues out there that just weren't touched at all in the budget. But let's have a look at the personal tax position. The first one up is the Medicare levy. One of the issues here, or not issues, but the government had previously announced that they were going to raise the Medicare levy to 2.5%, and they've resolved to keep that at 2%. And essentially that's just the improved economic and physical position of the government. They were increasing the Medicare levy to 2.5%, essentially to fund the cost of the NDIS. But the government's of the opinion now that they can actually meet these costs out of just general expenditure in the budget. There's also been some small changes in the low-income thresholds for Medicare levy, which means that low-income earners won't be paying the Medicare levy until a slightly higher amount. The major change is the personal tax changes, and that's basically brought around in a three-step process. The first step is they've actually changed or planning to change over the next 7 years the thresholds through which individuals pay their tax. Essentially, this current year that we're in, there's no change. And then as of 1st of July 2018, we can see a change in the 32.5% bracket there, where they've lifted it from 87 to 90,000. Not a significant change. And that'll be in place until 1st of July 2002, where they then start to move the 19% bracket up to 41,000 and further increase the 32.5% bracket up to 120,000. And then in the final year, which is the 2024-2025 year, they've increased the 19, or left the 19% at 41, but they've increased the 32.5 to the 200,000 mark, and they've eliminated the 37% bracket, and anything over 200,000 is taxed at the 45%. So there's significant changes there, and again, just on the aspects of Parliament at the moment, I think the opposition has indicated that they're happy with the first trench of changes, but they're not particularly happy with the 7-year outlook. So, again, a lot of this is to be seen where it ends. So when we have a look at what does this actually mean to someone and the levels of income, you'll notice that someone on $40,000, there is tax savings there. And one of the criticisms when you look at this table is that in year 7, when you look at someone on 200,000, they're having a major tax saving. So this is going to be one of the issues that the government will need to work on, is just, they've promoted it as tax savings for low income earners, but at the end of the day, it looks like the high income earners are getting a fairly significant saving at the end of the 7 years. One of the ways the government has looked to, I suppose, lessen the impact or to improve the distortion here is in the next policy that they brought in, which was the personal tax offset, which is, when we look at the personal tax offset, this is something that the low and middle income earners will have access to essentially from 1st of July 2018. And this is the $530 that people have been talking about. So this is an offset that you're able to claim when you lodge your tax return, and this will get offset against your tax payable, and so therefore increasing your potential tax refund by the $530. It is, again, phased in for the lower income earners. So when we start to look at the low income earners, effectively the $37,000 to $48,000 brackets, they will get the full $530. Then between $48,000 and $90,000, they'll also still get the main full maximum benefit of the $530. And then once you get over the $90,000 to $125,000, the offset starts to decrease. And essentially, once you go over the $125,000, you're no longer eligible for the offset. So that's sort of one of the ways the government is looking to compensate the lower income earners. One thing to bear in mind, obviously, this is a non-refundable offset, and so essentially what that means is if you don't have any tax to pay or don't have any tax to offset this rebate against, you don't actually get a refund of what you don't use. So that's pretty much the personal tax cuts, and again, follows on from the government's policy of reducing taxes to try and stimulate growth. The next area we look at is the small business owners, and essentially their main aspect out of the budget was the $20,000 immediate write-off of purchase of plant and equipment has been extended for another year. This was due to cease as of 1st or 30 June 2018. but they've pushed it forward for another year. It's quite a positive deduction for small business, and you'll see there that the small business definition is now someone with an annual turnover of under $10 million. So it's a benefit that's accessed by quite a lot of small business owners. Some of the other things in the budget that didn't sort of get a lot of attention, there was essentially a significant amount of money being spent on what they call compliance and integrity systems, things like increased data matching and review of income tax returns, also a lot of review and examination of what tax agents are doing. There's also a measure in there for high-profile individuals who use their image and fame through related companies. So in other words, they can license a related company to use their image and fame. They've brought in a section to make sure that that income that related entity generates is now to be taxed in the hands of the individual as opposed to in the hands of the company. They're also looking to tighten up the R&D incentives that are around. They're looking at taxing digital businesses that operate across border. Some of these are quite complicated areas. They're upgrading the Division 7A, which is loans by companies to shareholders and related entities. They're looking at tightening up the what they call unpaid present entitlements to companies. There's a lot of anti-avoidance measures in there. Some of the left field things that were in there, which was quite surprising. They've actually had to disallow deductions on vacant land, which was quite a surprise. I wasn't quite sure how anyone was going to go about, particularly when you're talking about just vacant land not being used in a business or anything like that. I was curious as to what people thought they were able to claim in relation to the vacant land. Also, there's a 5-year tax exemption for the International Cricket Council, if you're interested. There's a World 2020 coming into Australia in the year 2020. And essentially the government's given them, the ICC, a nice tax exemption for 5 years, which is good. Some of the other more targeted ones is particularly with small business. When a small business deals with a supplier, they're required to get the supplier's ABN. The ATO it's now being legislated that if you don't get an ABN, you're not going to get a tax deduction for the payment. The same goes for payment of wages to employees. If you're under an obligation to deduct tax and you don't, then you're not going to get a tax deduction for those payments. They're focusing on the black economy. They're developing what they call mobile strike teams to hunt out the black economy. They're increasing audit. They've got a hotline. They're doing more computer analysis, information sharing and education in regards to the black economy. So that's always a target. And I think they're focusing on, part of the significant stimulus into the revenues is coming out of illegal tobacco sales, or their expectation of getting revenue from those. There's also a limit on cash transactions of $10,000. So if you want to claim the GST on a transaction that's over $10,000, you need to process that transaction as a electronic transfer or some other payment, but you can't pay it in cash. There's also a significant increase in what they call the reportable payment system, which is predominantly in the building and cleaning industries, where builders, if you hire a subcontractor, you have to report to the ATO on an annual basis how much you've paid that contractor during the year. That system is being extended to the security industry, the road freight transport industry, and computer services. So they're essentially trying to tighten up the revenue streams that they have with into the government here. So look, that's the predominant changes in the taxation system. Again, nothing, no major tax reform. There's been some calls for the major tax reforms, but given our 3-year cycle of government, and we're up for an election in the not too distant future, there's nothing really significant in these tax changes. So now I'll pass back to Tony, and we'll have a look at the superannuation changes.
Superannuation. Look, it's outside looking in. I'm going to say that it has been positive in relation to superannuation, and that's on the back of the last number of years where it has predominantly been negative, whether it be cutting caps, contribution caps, non-concessional, concessional, and so on. Could they have gone further in terms of making it more positive? The answer is certainly yes, but they haven't done that in relation to caps. So while not as significant as the changes to super we've seen in previous couple of budgets, there are a number of proposed changes to super. And these do include opt-in in relation to insurance requirements for certain members, changes to protect small super balances. There's work test exemption for recent retirees with super balances of less than $300,000. An increase to the limit on members in self-managed super funds. Reduced audit requirements for eligible self-managed super funds, and changes to address certain inadvertent breaches of the cap as well. And we'll cover off on these now. So, insurance cover and opt-in. The date of effect is the 1st of July 2019, and in many insurance funds, including MySuper and employer funds, insurance is offered as a default option. It's proposed to move from this default option to an opt-in basis for members with balances of less than $6,000 and who are under the age of 25 and whose account has not received a contribution in 13 months and are considered inactive. And this is one way of protecting member balances, especially for people that are under the age of 25, where insurance is sometimes a compulsory as part of the superannuation program or corporate superannuation. So what will happen as a result is that now it is an opt-in option. This will commence on the 1st of July 2019, which means that individuals have 14 months to decide whether to opt in to the insurance cover. It's important to understand this opt-in applies to existing cover, so it's important to seek advice to understand whether or not you should opt in to insurance from this date. Protection of small super balances. The government has proposed measures to reduce the impact of fees on low super balances and focus on returning lost super to individuals. So they've come up with protection will be provided to superannuation accounts by limiting admin and investment fees to a 3% annual cap. This cap will apply to account balances with a balance below $6,000. Exit fees will also be banned on all superannuation accounts, which is good news. And a $6,000 threshold will apply to inactive superannuation accounts. So these accounts will be required to be transferred to the ATO. The ATO will increase the data matching activities to return amounts to active super accounts held by taxpayers. So what we are seeing here is greater data matching, ATO taking more control and being able to return superannuation to their rightful owners, especially if it has been lost. And that's been happening more so over the last 2 or 3 years, but this is certainly one way to get more superannuation back into the hands of those who have earned it. Work test exemption. A person aged 65 to 74 at the moment is able to make contributions to superannuation if the work test has been satisfied. So that is, a work test is working at least 40 hours in a 30-day period consecutive. In the financial year, the contribution has been made. A 1-year exemption from the work test will apply to older Australians who have less than $300,000 in total superannuation savings. The 1-year exemption applies to the financial year following the last year the work test was satisfied. So this will allow an additional period of time for those eligible to contribute to superannuation. So I'll use an example here. We'll pick on Mary. Mary ceases full-time work in 2018-19 at age 66. Her total super balance is less than $300,000. And under the current rules, if Mary wanted to contribute to super in the year 2019-20 and meets any other eligibility criteria, she would need to meet a work test. However, under the proposed changes, Mary would be able to contribute in that year without needing to meet the work test, as long as her balance at that time is under $300,000. So that's something to take into consideration, and that's certainly a strategy that we'll be looking at for our clients with balances under $300,000. And there's a number of clients that continue to work beyond 65, or if they turn 65 in March and they continue to go on and work until December that year, well, they're 65 plus, and they would have to meet the work test. And then the following year, there's contributions that we can now make as well. So in the year 2019-20. So that is certainly a positive. Limits on self-managed super fund members. So at the moment, self-managed super funds are limited to having 4 members. This threshold will increase to 6 to provide greater flexibility for families to all be members of the same self-managed super fund. James, did you want to add anything to that at all?
Look, this is going to be a strategy that we'll need to examine going forward, particularly with the potential changes that, for example, the Labor government or Labor Party has indicated that they're going to look to stop franking credit refunds for super funds, for self-managed super funds. So, there may be a strategy here where we can bring in other family members within the fund and make concession or tax-deductible contributions and offset the tax that would be payable on those contributions against the franking credits that are generated from, example, the parents or grandparents being in the fund and in pension phase and having all of these excess franking credits. We may well be able to use the strategy to access those franking credits by using contributions for younger members of the fund. So there's some possibilities there, but there's a lot of issues that we need to look at there.
Yeah. And next up, self-managed super fund audit. So currently there's an annual audit required for self-managed super funds. And what they're proposing at the moment is that a 3-year audit, so every 3 years only. But that is based on eligibility, and the eligibility is that you must have 3 years of consecutively of clear audit and on-time lodgements of annual returns. So, James, I'll throw this back to you to add any other comments in relation to this, because you certainly see it more from an accounting perspective as well.
Yeah, look, it's an interesting one. This most funds don't have any issue with audit. I would say that the good 95% of funds don't have any issues and should be able to meet these criteria fairly easily. Which, yes, does take the cost burden of an audit off the fund, and that can range anywhere from $500 to $3,000 per annum. So there's a potential saving there for the fund. What I caution about is those 5% of funds that potentially do have issues. If they're on a 3-year, if they were good and on a 3-year hiatus from audit, they can get into a lot of trouble. And so a lot of the responsibility is going to come back to the accountant preparing the financials and tax returns to ensure that there's no issues developing within the fund in that 3-year period. But essentially, it will be a cost saving for those funds who are basically doing the right thing, don't have any breaches, and lodging on time. They will get essentially a 3-year saving in audit fees, but still have to pay for the compliance, preparation of financials and tax returns. All those obligations are still there. It's just the audit obligation that is removed.
James, would you see any pushback from the ATO or any other bodies out there in relation to this?
Not really. I think I think the ATO only really require the audit because that's what SIS requires. The superannuation legislation, I don't think the ATO will have a problem with it. No, and from what I've seen so far in commentaries, none of the professional bodies have got an issue with it. I think, as I said, the only issue that I can see is that where funds are left to their own devices for 3 years without getting some good oversight. If the accountant isn't providing good oversight on the fund, when it comes to audit, the auditor may be facing a bit of a mess. Yeah, that's the only issue that I can see.
Yeah, very good. Inadvertent cap breaches. So employers are required to pay superannuation guarantees based on individual employees' income. For some individuals, what this means is that their concessional contribution cap is breached by the total of multiple employers' compulsory contributions. So if you've got multiple employers, you've got 2 or 3 employers, and in total you're earning in excess of $263,000, 9.5% of that is your $25,000, which is your cap. And so therefore anything over that is an excess concessional contribution. So you will now have, this is date of effect of this one is 1st of July 2018, and you will now have the option to elect to no longer have the contributions paid on certain income from your employer. So this overcomes the inadvertent breach of the concessional contributions cap and associated tax penalties. Instead, you may be able to make arrangements with your employer to instead direct these additional amounts to you as salary. Of course, it's important to seek tax advice and speak to your accountant in relation to this as well, and your financial planner. James, any comments on that?
No, not really, Tony. I think it's just become inherent that the employee can just manage their contributions going forward, and they just have to essentially be cautious of their non-concessional contribution so that they don't exceed their non-concessional contribution cap as a consequence.
We'll now touch on Social Security and pension loan scheme. So date of effect for this policy is on the 1st of July 2019. And what we are looking at here is that the pension loan scheme allows eligible individuals to access some of the equity in their home or other property via a government loan, which is advanced in fortnightly instalments. The scheme will also be available to all Australians over pension age, and the maximum loan payments will increase to 150% of their full age pension. One too far. So for a full age pension recipient, the total fortnightly payment they can receive may be up to 150% of the full rate of pension, which means that based on the current rates, a single person could increase their annual income payments by up to $11,799 or $17,787 for couples combined. A person who has no age pension entitlement may be eligible to receive a larger fortnightly loan instalment. This could be up to $35,397 for single people and $53,360 for a couple combined. The one comment I would make here is this is, I guess, touching into parts of the reverse mortgage side of things where I can tell you that reverse mortgages have been around for a very long time, for over at least 10, 12 years, close to 14 years plus. And there hasn't, from my experience and from across the group, there hasn't been a large take-up of that at all. This, however, may be something that clients seek opportunities in, and if that's the case, we'll certainly be able to assist them with that.
Excuse me, Tony, have you heard any comment in regards to is there interest on these loans, or are they? How do they?
I've heard absolutely nothing, and I've read through multiple documents since Tuesday night, and there is not much information at the moment. And with the release date being next year, I think there's a lot of water to go under the bridge with this one before we're able to find out exactly the full details. So,
okay.
On that one, I'll say certainly watch this space. Now, work bonus. And I'm going to skip to the slide which I'm going to skip to the proposed slide. So what's happening here is there is an increase to the pension work bonus from $250 to $300 per fortnight to allow pensioners to earn up to $7,800 each year without impacting their pension. This will extend the pension work bonus to allow self-employed retirees to also earn up to $300 per fortnight without impacting their pension. So self-employed retirees weren't able to access that to begin with. It will also amend the pension test rules to encourage the development and take-up of lifetime retirement income products that can help retirees manage the risk of outliving their savings, and expand the, we've covered the pension loan scheme, so I'm not going to cover off on that either. But this is something that is a positive. We do have some clients out there, or in fact many clients out there, that do continue to work and earn a little income on the side. So this is seen as a positive out there. Aged care. Go back one. And this is from the 1st July 2018. So funding for home care services and residential aged care will increase, including 14,000 new home care packages over 4 years and 13,500 new residential aged care places, and grants for aged care facilities in rural, regional and remote areas. So certainly the government's taken note that there is certainly a growing demand in this space, and that they are increasing the amount of money that they are contributing to this area. Is it enough? The answer is certainly not. And this is certainly a big space moving forward. And you'd envisage that over the next number of years that there'd be more money in this area. So let's look at opportunities. Superannuation. Super continues to still be attractive for retirement savings. There's an opportunity to contribute as a recent retiree. There's protection for smaller account balances, whether it be for yourself, for your kids, and consider your need for insurance before opt-in arrangements. So for those people that are eligible for that, you have 14 months. Once again, that's based on everything being passed. Taxation, personal tax cuts from 6 years from 1st July 2018. Tax cuts are significant for some by 2024, and there's no change to the Medicare levy for now. Social Security, relatively minor changes for most, may now qualify for the pension loan scheme. There's favourable assessment of employment income and great news for the self-employed. So what's the impact on me? In terms of time frame, we haven't been able to cover everything that's been in the budget. There's a number of other, a lot of small detail in there as well. So I would say certainly make an appointment with your advisor or your accountant to understand how these changes may impact you and how you can maximise these opportunities. And we will certainly be able to assist you with that. Any questions so far? And James, I'll pop it back to you in relation to questions.
Yeah, look, if anyone has any questions, I believe you're able to send us a question through the internet there. Look, I'll just, with the budget, my end comments overall is that the positive thing is that we're heading to surplus. The positive thing is that we've got the government's forecasting good growth. They're forecasting wage growth. So it's a very positive budget. but then within it, there's no significant changes or reforms, particularly in the area of tax. Certainly, there's some tweaking in the tax rates, and there's again, as Tony said, a lot of water to go under the bridge before we actually see legislation and some clear understanding about how things are going to work. And as I mentioned earlier, it'll be interesting to see what the Labor response to the opposition's response to the budget is, what they're going to agree to, what they're not going to agree to, and just to throw, I suppose, some added mix into that, we've now got a number of by-elections going to happen, so we may even have a change of faces within the federal parliament, which might change the dynamics of how this budget will proceed through the parliament. So it's nothing's in concrete yet, but yeah, it's an interesting time.
Certainly interesting times. Certainly interesting times. Just a reminder to everyone out there, we've got 3 decades of experience, wealth of financial intelligence, and award-winning client care with a one guiding vision. So in terms of the services that we do provide, it does certainly include investment advice, retirement planning, personal and asset protection, so protecting what's important to you, intergenerational estate planning. How does your assets flow through to your family members or to your beneficiaries, whoever they may be? Certainly business accounting and consulting services, cash flow and debt management, business structure and succession planning, tax planning, and James, you'd be busy now with tax planning, finance and lending, superannuation, including self-managed super funds. We certainly have a team nationwide that can assist you, from our executive planners, accountants, business advisors. So we do make the difference to your life so that you experience your lifestyle potential. So on that note, next steps, seek professional advice from a qualified accountant and or planner. You can contact us on the 1300 888 803 number and come in for a coffee and a chat about how the federal budget may impact you. And the following are the upcoming events that we have planned. So on the 28th of May, a one-page business plan, Your Path to Profit and Growth. 29th of May is Using Your Metrics to Drive Your Business Growth webinar. And on the 30th of May, Managing Your Cash Flow for Growth Breakfast. To register for these events or for more information, you can log on to www.modoras.com/news-events and find out more information from there. On that note, James, is there anything you wanted to add to that? Or...
No, look, I just thank everyone for attending and appreciate them their time, and I hope that we've added some ideas to your tax affairs and given you some insight into the budget. Thanks, Tony.
Thanks, James. And on that note, we haven't got any questions that have come through. So on that note, I might just give it a few moments and see if anything does come through. But if not, thank you for your attendance today, and we look forward to seeing you soon. Thank you.
Thanks so much for joining us. We'll now call webinar closed. Have a good day.